Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. It is June 7th, 2024, and I'm here to bring you trading levels in the major market indexes for the upcoming week of June 10th, 2024. We'll take a look at the SPY, the triple Qs, the IWM, as well as the bonds, as represented by the TLT ETF. In the past week, the market actually hit another another 52-week, and of course another all-time high. And if we take a look at the SPY here, right now we finished at a close here, just off the all-time high here, uh, roughly around 536 and a half. We're now back at about 534, so we're right off of the all-time high. And in fact, last week when I did this video here, we were actually looking at this formation right here. This was on May 31st, so this was precisely a week or so ago. And right here, we were looking here at a rally base drop formation. Right here, price had rallied up here, consolidated, and then it began that drop here. Okay, and so right in here, we can think of the shares that were offered up by sellers. We can think of those as supply. Okay, and then we can also think of the shares that are acquired by the buyers. We can think of those as demand. And so within here, supply and demand are in balance over the course of these 2 days here. And this is because this is a 2-hour chart. In here, supply and demand are in balance as shares get shuffled back and forth within this relatively narrow 1.5 point range for the SPY. And then, of course, right here, there was a situation where there was an exhaustion of buyers. But no one was willing to buy here anymore. And so at that point, then an imbalance got created. And so where there was supply and demand within this region, all of a sudden there was no longer any demand. And so the thing that we look for in terms of the foundation for our trades is that we are waiting for price to return to either a level of supply, which is here, or down here, which is a level of demand, okay, created by an exhaustion of sellers. Okay, we're waiting for price to return to one of these regions, and then this is where we would express a trade. Up here, we would express a bearish trade out of this supply zone here, okay, and down here we would express a bullish trade out of this demand zone. Okay, this is an area up here of what we expect to be future downward price pressure. Down here, this is an area of demand where we would expect future upward price pressure. And so we're waiting for price to reach one of these two levels, and then this is where we would express a trade. And of course, we could express a trade in any number of ways. Here we could of course short the stock. Here we could buy the stock. Okay, the S&P, the SPY, and of course, another way we could express a trade here would be up here to buy a put, and down here, of course, we would buy a call. Okay, in both cases, we would be taking advantage of the anticipated bounce out of here in order to basically catch a bullish move. And of course, up here, we would be looking to express a bearish trade and look for a drop out of this supply zone. So that's what we were looking for last week. And if we now flash forward a little past that, that's what we were looking at then. And then we can see, okay, on when the next week arose on that Tuesday, we ended up getting a spike up into that supply zone there. And then over the course of that day, we actually ended up with a real nice trade here with our subscribers here. And so we caught that bounce from about 529 down to about 523. Okay, and in fact, what we actually did was we did this on a confirmation basis. So we actually waited because price had actually gapped up right into the bottom of that zone, and we didn't really know where it was going to go. So we actually waited for this thing to drop about 50 cents. And so when it got from about 529 to about 528.50, that's where we actually expressed the bearish trade, and most of our subscribers bought puts at that point then. And so they basically we all rode this thing down from about 528 down to, anywhere between, let's say, between 523 and 524. So that was about here. If you wrote it all the way to the bottom there, that was about a 2.5 to 1 trade. Okay, this is where our entry was going to be. Okay, and then our stop was going to be just above that supply zone there. So that 2 points there. So that's 1 unit of risk. That's 2 units of risk. That's 3 units of risk. And of course, we actually got in a little lower, so that kind of skewed that a little. But more or less, that was about a 2.5 to 1 trade, getting down to that region there. Okay, so that was the story with the. That was the story what we had early this week. So now if we go back to the live chart there, this is what I just showed you here. And so now here's what we're looking at right here. So right here, we actually have an area where there is this consolidation here. This is a potential demand zone. We're a little wary of this because of the fact that it's actually kind of sitting in between these other zones here. And more often than not, when you have zones that are either fresh demand or even in this case, this is tested demand here. Okay. When you have a whole bunch of zones that are in rather close proximity, when you actually have a zone that goes in between it, more often than not, it's going to be a less a trade with lower probability. So this is a demand zone here. However, we're going to be kind of cautious about this one because of the fact that it's sitting right below a tested supply. Right here, this is tested demand, and so the fact that this is sitting in between here, this is a lower probability trade. This is like at best a B setup. It's certainly not an A or an A plus. Okay, so but in comparison to where we are now, that's about 1.5% down in terms of current price. Okay, but really the fresh zone here is in terms of demand is probably down here. But that's about a 4% drop here. So we would be looking for some kind of, a reasonable pullback. So really what we're hoping for is we're going to see a pullback and then some other level of demand will get created over the course of the next few days. And then that'll be the basis for a trade there. So, but we'll keep an eye on this one. The way we would take a trade out of here, though, would probably be like what I showed you on that earlier SPY trade, would be what's referred to as a confirmation entry, where we would look for price to dig in here. We would not immediately get in the trade, but if it does reverse and show a clear sign of coming out, then we would take the trade. But we wouldn't just take it on faith that it's going to bounce off this front line here because of essentially the neighborhood that it's in here, which is kind of congested with all this other trading around it. Okay, so that's the SPY. Before I go on here further, the usual disclaimer, of course, Precision Trading Labs, we are not financial advisors or money managers, so none of this should be construed as investment advice. Everything we do here is for educational and information purposes only, and it's to help our subscribers to become confident traders. So anyway, that's the story with the SPY. If we turn to the triple Qs here, which of course is the S&P of the Nasdaq 100, right here, here's what we're looking at right here. So here's where we were last week, okay? And then more or less you're looking at more kind of the same formation here that we were looking at in the SPY. However, the interesting thing here is this while this looked like that same level of supply that worked on the SPY chart, this was, nothing. It really just didn't react at all to it. It just kind of went through like a knife through butter. So it's not like this is sitting in the midst of underneath tested supply where we saw that on the SPY. So in fact, I would probably be. This is not an A plus setup, but I feel better about if I was going to take a trade in this region. I would take this trade probably off the Qs and not off the SPY. A lot of times the markets, of course, will kind of more or less roll in tandem to each other. But here and there, they will kind of behave a little differently. And I would actually expect the Qs to be probably react better to this level than the SPY for the reason that I just said before. So we'll keep an eye on this level here. This is about 2% down. I think on the SPY it was about 1.5% down. So this would have a little further to go here. And then right here, here's an area of tested supply here. And again, that's a fair distance down. That's about 5.5% down. Okay. Of course, we're sitting at an all-time high here. So there is no supply overhead. Okay. If we take a look at the IWM, which is the ETF of the Russell 2000, um, here's where we are. Here's where we're sitting now. Okay, and then right here, so here's where we closed at around just over 200, about 201. Okay, and in terms of where we, in terms of the next area of supply, that's probably here. Okay, and that's about 3%, and this is more or less the same level structurally that we saw on the, I think on the SPY chart that actually held. Um, you can see there was kind of a couple of near misses here, kind of a couple of approaches, but nothing actually transpired from this. So these are still fresh levels. This is still a fresh level here, but it would have to get up about 3% in order for us to express a bearish trade here. Okay, and then underneath, we really don't see a whole lot. There's just one series of tested demand after the other here. And we could think of these areas of tested demand really as support. Okay, right here we had our rally-based rally formation. Price came back into this. It did wick through, but if you notice, there were no closes within here. Or I should say, there were no closes beyond this zone here. There were a couple of wicks, but then it immediately recovered, but there were no closes. So we can think of this more or less as kind of sloppy support. It's kind of tested demand here. So this is not an area where we would be looking to go long at it or to really to express a bullish trade. And then right here underneath, again, this is an area where there was a rally pip base rally formation. Price came back, bounced out of it, came back again. Okay, came back yet again, bounced out of it. So while this is, some people would look at this and go, well, this is support. At this point, I consider this to be kind of beaten up support. So I really don't, on the Russell, I really don't see a whole lot that's appealing on the long side here. So the only thing I would really be looking for on the Russell is the opportunity to short out of this supply zone here. But other than that, I really don't see any clean demand unless you kind of drop the time frame down to, let's say, certainly under an hour. You might see something in a 30-minute or a 15-minute chart, but I certainly don't see anything in what I would consider to be a swing trading time frame here. So that's the story with the IWM. And then lastly, we'll take a look at the TLT. The TLT, of course, is the ETF of the longer term bonds. So it does not include the 10-year note, but this is basically the 20-year and beyond. So that's the TLT here. And so there are definite areas of fresh demand here. Here's where we were last week. 531. So here, right there, this is where we were last week. And in fact, right at the end of the day, this little area of consolidation had occurred. But at the time, we really didn't, I had no inkling, of course, because this is where it closed on Friday. But ever since then, the bonds rallied this week until today, where it kind of pulled back. But right there, that created a demand zone here. So in fact, we could be looking to express a bullish trade out of this fresh area of demand on the TLT here. So that's obviously only about 1% down. So we could certainly see a pullback here. So our entry for that would be 90.65. Our stop out would be 50 cents below that at 90.15, which is about a dime beyond the back line of this demand zone. And of course, one could express a bullish trade here. So one of the things we could do is to buy a call, and we would probably buy the call with the 90 strike, so that we would buy even maybe even the 89 strike. So we would be buying this a bit in the money. So we would be running a delta of, let's say, 55, 57, or 60, something in that territory, and we would buy it about, with enough time so that we would not get beaten up by time decay if for some reason this thing just decided to stall here. So we would probably buy this with generally at least 60 or 75 days to go. We would not be in the trade anywhere near that. But if we happen to get stuck in the trade for, let's say a week or 10 days, then we wouldn't get beaten up by time decay, because with the fact that we would have obviously a bunch of time left to go till expiration. So that's how we would express the bullish trade out of here. So that's 1% down. And then in terms of the of where we would be looking to short, That's, I think, the quality supply zone, about 3.5% up. This is an area of supply right here overhead. I'll just mark that here. Okay, and that's obviously only about 1.5% up. Uh, Again, we're kind of in between these two levels here, and I don't know. I would tend to think that this might actually be the better level up here. It's got a better, I think, risk reward proposition that's going on here in terms of the length of the move down. So that's probably what, because right here, this is really just, there hasn't been a whole lot of follow through. This was just one drop. There was a gap, and then it just, and then today it just kind of really didn't go a whole lot. So this is not a tremendous amount of follow through here. Over here, on the other hand, you had a drop, it can decay, and then it dropped again. So I think there was a little greater energy coming out of this. So I would be looking to actually express a bearish trade out of there. Okay, and so in terms of distance, that's about about 3.5% where we are here, and then this demand zone here is about 1% below where we are now. So anyway, that's what I got on the indexes. This is Mitch Firestone. Thanks very much. Bye bye.